Hi, my name's Trent Doughty. I'm the managing partner at Kelly Partners Private Wealth. Today I'm joined by Ben Coughlin, who's the CIO of AVARI Capital Partners. Ben, do you want to just start off by giving us a bit of an introduction to who you are and how long you've been at AVARI Partners and more about your CIO role?
Certainly. So look, I have been at AVARI Partners for the last 2 years. I joined their investment committee about this time 2 years ago. And, AVARI is a specialist real estate funds management business. We currently manage about $1.5 billion of real estate assets, which is broadly split between private credit, about $1 billion, and direct asset investment, about $500 million.
And Ben, I guess you've had a front row seat across multiple credit cycles. And before we get into the mechanics of what is your core philosophy when it comes to risk in private mortgage lending, how do you think about the job?
Well, look, I think the job is it's very simple. We are the custodians of other people's money. And so we have to take responsibility for investing their money like it's our money. And we should only invest in things that we would invest our own money into. And when you look at things through that lens, it does make decision-making much more straightforward because, we do invest our own money alongside our clients. And it is a certain level of clarity that makes life simple.
And just in terms of credit cycles, where would you say we are in this current cycle?
Well, look, it's been quite a long, benign cycle, really. The last meaningful credit cycle that I lived through was the GFC. And I think if you've lived through the GFC, then everything after that seems quite pedestrian. That said, I think, for real estate credit, there has been a marked shift in the participants in the marketplace. If you roll the clock back to GFC times, it was dominated by the local banks and offshore banks, the likes of the Lloyd's group, for instance. And they've left the market, and that vacuum has been filled by private credit providers, such as us. And there is a different source of capital sitting behind private credit versus the likes of the international banks. So, banks are heavily regulated. Private credit is currently not heavily regulated, but ASIC are exploring additional regulation in the space. So, look, the market has changed. The sources of capital have changed, and how that evolves into the next credit cycle will remain to be seen. But there will be another credit cycle.
Can you just walk us through that underwriting process that AVARI undertakes and, from first look of approval to, what does a loan have to pass through before it actually gets into the portfolio?
Absolutely. Look, we have a very flat structure within the AVARI business. So the majority of the deal team is located in very close physical proximity. And so, when a transaction first is introduced to us, and we would see on average 50 to 100 transactions a week. The first thing we do is a desk side screening of that transaction, and that's very, very high level. But what that does is kick out the transactions that we have very little interest in, and that will be somewhere between 80 to 90% of what we see. 4 or 5 a week might get through to a more detailed review for discussion at an investment committee, which occurs once a week. And that, again, will be more of a deal creation type discussion where we're interested, but we're interested on certain financial terms. And so we'll put forward a proposed set of terms, and in part the transaction or the dance there is, in some instances will be too expensive for our client or for our borrower, and the transaction won't progress. In some other instances, will be taken forward into a more formal process. Then it gets really interesting. That's where we do a deep dive on the business plan that has been presented to us by the borrower. And, as an example, for a construction project, for a civil construction project, a land subdivision, we will look at the end product and we'll look at the valuations on the end product and make sure that we're comfortable with that. That will be a combination of third-party valuations as well as our own internal reviews. We'll review the cost plan for the civil works. We'll do that through a review of a quantity surveyor's report, an independent quantity surveyor's report, but we'll also benchmark it against other transactions that we've participated in or seen, and to make sure that it lines up. In the perfect world, you have a fixed price contract to deliver those works. We'll review that contract and make sure we understand if there's any moving parts, any provisional sum items, any rise and fall that which could change the cost of delivering. We'll understand the council contributions. So we'll understand, what statutory contributions is the developer obliged to make? And we'll get to the bottom of a line-by-line analysis to say, this is what it's going to cost to deliver this business plan. And then we'll assess the profit that is being generated and whether the risk return at the overall project level is good enough to support the land value, which is the last piece of the project. And if that all it meets our criteria, then we'll go into the legal documentation process. And again, the legal docs will largely reflect the business plan that our borrower has put in front of us. So there'll be milestones to say, you said you'll finish the civil works within 6 months. So maybe we'll give them 7 months in the as a milestone in the documents to allow some slippage, some reasonable amount of slippage. Yep. But if it gets beyond that, then we need to have a conversation and work out, how do we fix this? So the documents will give us certain review rights to make sure that things continue to be on track. Sales milestones, understanding of LVR covenants, and if there is a shift in the market price for the end products, again, that gives us a right to go and have a conversation with our borrowers and look for a mutually acceptable way to remedy a problem that might pop up in the process.
Yeah, that's really good. I mean, I think, looking at this space, I think the valuation of the property is so critical, because I think that's where a lot of lenders, private lenders, have got themselves into trouble, where they've, lent against property valuations that are not realistic. And then, they found out later that that's, caused huge problems. But also to the feasibility of that and the due diligence that you guys do, I think is so important, because, I think, once again, I think there's a number of lenders out there that sort of, brush over the feasibility and go, we'll just lend based on whatever the LVR is, without actually seeing if the project itself stacks up. So that's really good to hear. So just on that, on the LVR, it's obviously a headline metric. What loan to value ratios are you typically comfortable with? And how conservative are your assumptions around those valuations and exit strategies you just mentioned?
Look, it's a very good point. The valuation is critical to get right. And in terms of third party valuations, the valuations are only as good as the assumptions that are given to a valuer, and that's really what you need to test. Is this valuation optimistic in terms of its assumptions? Because if you're lending to the wrong V, then that's where you do, and we have seen examples of lenders getting into trouble. And look, that's not just in the private credit space. That's even if you go into mainstream banking. A large part of problem assets is where there's been a diligence failure up front. So look, we are very rigid in our approach to assessing valuations and making sure that we have done our own internal comparable analysis to ensure that it's an AVARI valuation and that we can stand behind that. In terms of where we're prepared to go in terms of valuations, well, our book weighted average valuation currently is 58% or thereabouts. That's across the portfolio. Our maximum LVR will be 75% in exceptional circumstances.
Mm-hmm.
We don't often go to that,
Sure.
but on a completed product where we're very comfortable with the end market, where we will occasionally go to that level, but typically we're in the 60 to 70% LVR levels.
Yeah. So just, I guess, beyond the numbers, talking LVRs and that, obviously that's really important, the valuations and the LVRs, but, what makes a borrower or sponsor, genuinely attractive to you?
Well, look, the things that we typically look for in a borrower is, as simple as this sounds, it's honesty. You do want borrowers to be transparent in the information that they give to you, and for that information to be clear and complete. And it's a real red flag for us if, when we get into diligence, we discover things, which we often do, unfortunately, that had we known that at the outset, we wouldn't have wasted our time in pursuing an opportunity. And that's where thorough diligence matters, because you do need to turn over all the rocks to make sure that you don't find yourself in a position where you get an unpleasant surprise down the track. So borrowers' honesty is a and that's tested through the diligence process. And we'll go to track record. We'll look for look through credit history. We'll look, have they delivered a project of the nature that they're describing to us or they're proposing to undertake. And track record is important, but there are mitigants to having an imperfect track record, and that might involve bringing in third-party oversight to make sure things stay on track. But honesty and track record are in both the credit and the project side are really important things to try and weed out in terms of our borrowers.
Yeah. So if we think about the LVRs again, and you sort of mentioned at the moment it's around sort of 58 across the blended portfolio, and then sort of around that sort of 60 to 65 level. Do you stress test the loans for scenarios like a 15 to 20% fall in property values or project delays, or a refinancing squeeze and that? Do you do that sort of level of detail as well?
We do. We do have sensitivity tables that are incorporated into our approval processes. And so they'll be both standalone sensitivities, what happens if market values decline by a certain percentage. And they will also incorporate a level of the costs involved in a recovery exercise, because they can be meaningful if you are having to work through a recovery process. We'll also do joint sensitivities. So what happens if construction costs increase by 15% at the same time as the property market falls by 20%.
Yeah.
And we'll make sure that there's enough headroom in our asset value to be able to absorb an acceptable shift in market parameters.
Yeah. So, that's really interesting, and obviously extremely important to protect investors. We spoke before about sort of credit cycles. Have you seen sort of different market cycles? I guess, what lessons have, shaped how fund managers, risk today and, things in the industry that got wrong in previous downturns and, you're deliberately sort of, safeguarding against those?
Look, I think that the short answer is yes. And, we are very cautious. So things that, as the credit cycle evolves, there's a certain point in the cycle, which I think is probably behind us now, but where credit terms are loose, covenants are loosened, pricing is tightened, and that's in the most exuberant markets, probably precisely when you should be doing the opposite. Flip side of that is when the market is in despair, often the loan terms and pricing is at its best, and the same investors that weren't prepared to invest or were prepared to invest at with no covenants and at low price are now not prepared to invest with tight covenants and high cost of capital and lower leverage. So, we certainly maintain a very cautious stance, but putting it simplistically, there is a trust in our process. And so if we continue to do the diligence that our clients expect of us, and that we would expect in investing our own money, then that will help us to be picking the best risk return in any given market. And our clients are, in terms of seeking investment or exposure to private credit, they are paying us to invest, and they're just paying us to invest well.
Yes.
And so that's the important thing to consider, because otherwise, if you were too cautious and you're sitting in cash, you're missing out on returns. So there is a trade-off and a balance that needs to be thought about in terms of credit cycles. But in summary, we're always cautious.
Yes. Yeah, it's funny. I always like to say to our clients, I think buying shares and buying equities, sure, that's something you can kind of probably go and do yourself sometimes if you do your research and do your homework. But doing private credit and property, back lending, that's not something you can go and do yourself. The process and the due diligence and that, it's full on, and not something that a lot of people can just go and wing it and do themselves. And obviously, you guys have the experience and the runs on the board and the process. It's worth the fees for our clients certainly to pay that to get that expertise. Without naming names, could you share an example with me on a deal that you passed on? I think that'd be really helpful just to kind of say, well, at what point were you looking at a deal and went, what, I'm going to just pass on that one?
Well, look, I think, the question on deals that we pass on, we pass on, as I said earlier, about 80 to 90% of the deals that come through the door. And at the outset, when you're first looking at a transaction, that's easy to do. So the deals that matter in terms of us making a decision to pass on them are the deals that you've gone all the way and you're at the finishing line, and then something pops up, and the temptation may well be, I've done all the work, I should close this deal. And they're the ones that you need to pass on, as opposed to, just came in through the door and we can see that this is not going to work for us. So look, we have, there's instances where we did a background check on a borrower and it turned out that they'd been involved in an attempted military coup. And so we decided that wasn't a client for us. No. The project looked good, but that wasn't a deal for us. We've found or discovered undisclosed liabilities on transactions, and there is a habit of some borrowers to take what's known as springing mortgages on properties, and they're basically taking credit against an asset and having all the mortgage papers signed but not registered, so that when something goes wrong, they can pop the mortgage in place. There's no way of knowing how many springing mortgages a client might have, but we have, again, discovered those sorts of liabilities and said, well, we don't know now how much debt there is against this project, so we just can't do the deal. So there's multitudes of reasons. Sales milestones might not be met, or sales prices we see that have transacted while we're going through diligence might not have been to our expectation. So again, in those scenarios, the disciplined credit manager will revisit the decision and, if necessary, reject the transaction.
Yeah. And of those transactions you have rejected, are there obviously, have you seen them sort of being financed somewhere else, and then ultimately the call you made was right?
Many times. And again, that is across both, the transactions that we reject very loosely and in an early high-level diligence phase, as well as transactions where we've got down the path and rejected, after discovering some adverse finding. Yes. More often than not, particularly the later cycle ones,
right,
they will end up in problems.
Yes.
And the buyer's remorse will have kicked in for whoever did ultimately do those deals. So we do see that, yes.
Yeah, okay.
Yeah. And look, again, the way we think about it, it's very important to avoid those losing transactions. When you're in credit, it's the returns are capped on the upside, so you're not getting equity-style returns. So the losses have a more meaningful impact in reducing the overall return across the portfolio. So it's super important to just miss those difficult transactions.
So just expanding on that, what do you think from separates, the good managers from the bad managers? Like, obviously, you guys have done a great job of managing risk and picking lots of winners, but what do you think separates, the managers who can navigate that volatility and avoid running into those serious problems?
Oh, look, I think in large part, process is super important.
Yep.
I do think experience really matters. Having seen credit cycles and knowing how bad things can get when they get bad, and how difficult it can be to recover in those scenarios, tempers your decision making on the way in, and that I think is is very important.
Yeah.
And as I said earlier, because we have been in a benign credit cycle for a fairly long period, it is easy to think that you can take more risk, particularly as the cycle becomes longer and longer. That's where, in my view at least, you should be being more cautious and being more patient in decision making.
Yeah, I think I think certainly for us, when we are doing our due diligence on fund managers and private credit managers, as you say, I think experience is a big thing. So if you've got grey hair or no hair, that's a tick.
Yes.
So yeah, I think experience is good. We talked earlier about valuations. I think that is really critical, like getting the valuations right, because if everything does turn to mud, having the proper valuation on the property, I think is really key. But I suppose for advisors out there like us and asset allocators, doing due diligence on private credit managers, what do you think are sort of important questions they should be asking, and what answers should make them nervous?
Well, look, I think one of the most important questions to ask is show me. And so, in terms of the way we approach the due diligence process of advisor groups like yourselves is we'll happily say, pick any loan in our portfolio, and we publish the full book to our investor base once a month. And we'll happily show you the due diligence we've done in the decision, in coming to the decision that we've made on that.
There's a lot of transparency.
There's a lot of transparency, but it also demonstrates the process and confidence in the process. And that's, to me, there's nothing like seeing the underlying effort that goes into that and understanding the level of work that's being done. Words versus actions, I think you really want to see the action, and we're more than happy to stand behind our process.
That's great. What keeps you cautious in today's market, and where we are right now? Are you seeing the best risk-adjusted opportunities for investors prepared to do the work?
Well, look, I would say I'm always cautious.
Yeah.
And we do often have conversations about not chasing deals. Stick to our pricing, stick to our terms, and if the deal trades away, then let it go. Because again, avoiding mistakes is more important than winning a marginal deal, particularly one that you might regret down the track. So, we always have a cautious stance, and I think generally prudent managers should always have a cautious stance. In terms of where we're seeing risk return, look, we do spend time understanding complexity in complex situations. And from time to time, we will take on exposures where there is some complexity in understanding the project. And that is something that does scare away certain managers. So we can, because of our process and because of the confidence that we have in our process, participate in transactions that have a degree of complexity that is being, in our view, over-rewarded by the pricing and the return that's being achieved on those situations.
Let me throw you a curveball.
Sure.
Federal budget.
Yes.
Is a big talking point amongst investors and investment advisors at the moment. What are your, without sort of taking political sides and stuff like that, what is your take on it in terms of, do you think it's going to have, a real negative effect on property? And obviously there's new property and then there's old property. How do you see the budget kind of affecting AVARI and what you guys do in terms of, once again, your due diligence and your assessment of deals and things like that?
Well, look, I think whenever there is a substantial shift in policy, like we saw in the budget in early May, there are unforeseen and unintended consequences. I think broadly, the changes that have been made will take some time to digest and find their way through property markets. I think that people are still working out what it means, and I think in part because it's not 100% clear exactly where the policy is going to land. That said, I think for residential real estate, and particularly existing real estate, there will be potential for softening of demand, with investors being less prevalent in the market. And I think that can have a negative impact on prices. I don't see it as being catastrophic, because there are still the counter balancing factors. Employment's strong, immigration's strong, housing supply is still tight. Rents are still supportive. So I see the fundamentals as still being strong.
I guess for new product too.
And for new product, potentially. But I do see that, there will be an adjustment period, and likely there will be some, modest falls in property prices whilst that adjustment period occurs. But then the market will rebase, and that as a known scenario, the market will balance again. So, look, we do incorporate that assessment now that the budget is out. We do need to incorporate the impact of the budget in our thinking. And again, we're being very cautious.
Final question, yields. So this is something that I get asked a lot. And you touched on it before about the competitive nature of the market and the fact that there's a lot of money has come into this space. And that's kind of driven the yields down a little bit. Obviously, with the Reserve Bank increasing rates, this year and late last year, are you seeing that those rates are now starting to sort of trend back up again, or is it sort of holding its ground?
We are seeing pricing improve slightly.
Okay.
And we are seeing terms on credit or credit terms improving.
Okay.
So I think, again, in terms of where we are in the competitive cycle, I think the height of the credit exuberance in the market is behind us.
Okay.
And I think in part that is a response, and a rational response to some of the reports on behaviours in private credit over the past 12 months.
Particularly the international ones, right?
Particularly international, but also, to an extent, some of the onshore, discussion with the ASIC reviews and the like, has meant that there is just a pullback in terms of competition in the space. Again, there's still plenty of capital in the market. It's just the market has softened somewhat, which again is for us, we see that as a good thing.
Well, Ben, thanks for your time. It was a good discussion, and on behalf of Kelly Partners Private Wealth, I'd like to thank you for the discussion.
Thank you.